Thank you. Well, welcome everybody. It is an absolutely gorgeous day here in the New York City area, so I hope it is equally gorgeous where you are. It is my pleasure once again to introduce our instructor, Ryan Reichert. Ryan is an EA and a CFP and is coming to us, I believe. Are you in San Diego
I
tonight?
am.
All
Yes, I'm
right,
back.
or this afternoon for you. And from San Diego. And also, as I've said before, Ryan just passed the U.S. tax court exam for non-attorneys. And so Ryan will soon be adding USTCP to his credentials. So we congratulate you for that. Ryan is widely known as one of the top tax minds in the country. He is a fast rising star when it comes to teaching in our industry. I've had the pleasure of attending Ryan's classes both online and in person. And we were also fortunate to have Ryan present at our October 2025 conference. You're in for a treat. Ryan is presenting this year for us a special mini series of 4 webinars in May and June, this being the last or the fourth of four. We're just so thrilled that you've been with us for these last three presentations. So we're thrilled that you're here tonight and thrilled to welcome you once again to the NYSSEA webinar series.
Great. Thank you so much. Okay. Let me get this shared and going. Okay. Hello, everybody. It's great to be back for this final in our four-part series. Really happy to be here. Today, we are going to be talking about the tax implications of family drama. So, as always, I've got my super fun picture of me at some conference somewhere. Don't remember where, but we'll skip right past that because I had a wonderful introduction. So, in this session today, it's kind of like the session that we did last week, where it's really a hodgepodge of kind of different subtopics that we're bringing together under this idea of family drama and the odd family situations that we see these days. And similar to the last session that we did, a lot of these rules are many, many, many decades old. And society has progressed to where we're at today, where we have lots of like non-traditional households, whether you have couples who are together and they have kids together, but they don't want to get married because they have some sort of views about marriage, or, you've got multi-generational households and all that fun stuff. And so, what we want to do here is kind of break down the issues that some of these households face in practice. And so that way you have an easier time applying the rules and instead of kind of spinning your wheels on, hey, what's the appropriate way to do, this, that, and the other when it comes to filing statuses, deductions, credits, where to report income, all that fun stuff. So, the first big topic in your handout is the head of household filing status. Now, I recognize that most people have head of household filing status down pretty well. And so I'm going to breeze through the head of household section and I'll just spend more time on some of the things that I think people need to just understand a little bit better. Just to kind of readdress it here, head of household, in my opinion, is one of the greatest filing statuses for an unmarried taxpayer because you get these effectively lower rates. They just make the brackets wider as far as how much income is taxed at what particular rate. And then obviously you get a larger standard deduction as well. Sometimes you can also have increased phase outs for certain deductions and credits, but we're not going to go over every single one of those here. So this set of qualifications, these core five qualifications, are what you really have to understand in order to determine whether the taxpayer is eligible for head of household or whether they're going to have to file, single or married filing separate or something like that. So our first and biggest qualifier is that the taxpayer either be unmarried or considered unmarried on the last day of that year. Now, unmarried means that you are either divorced or you have like a legal separate maintenance agreement. Either of those is actually unmarried for this qualification. The other option for considered unmarried, we're going to dive into in a little bit here because the rules do get a little bit niche and it does confuse some people. Okay. The second big qualification is that the taxpayer's got to pay more than half the cost of keeping up the home for the taxable year. The third is that a qualifying person has to live in the home for more than half of the year. However, if there's a temporary absence, the kind of best examples of this are if you've got a child who is going away for school, maybe they're going to boarding school in another state or in another part of your state, even though they're not living at home with you, they're still treated as though they lived in your home as long as they intend to return home after their absence. Okay. The fourth qualification is that the taxpayer is not a surviving spouse, meaning that they could qualify for the qualified surviving spouse filing status. And then the fifth is that you cannot be a non-resident alien at any time during the year. Okay. Now, to go into our first qualification a little bit deeper, the whole unmarried thing is pretty obvious, but it's considered unmarried where people start to run into problems. Okay. So a taxpayer who is considered unmarried for this purpose is technically still legally married to whomever their spouse is, but you've got to file a separate return. And so in order to do that, they need to be married filing separate, single, or in this case, we're trying to push them into head of household. They've got to pay more than half the cost of keeping up their home for the year, which is the same rule that we had for the, actually unmarried people. The spouse cannot live in the home during the last 6 months of the year, and you need to watch out for temporary absences. Okay. So maybe the spouse is in the military and they're stationed in some faraway land for 9 months, right? That's a temporary absence because they intend to return home at the end of it. So that's not going to push the taxpayer into, considered unmarried for this purpose. In the case of the considered unmarried component of this qualification, your home must be the main home of a qualifying child, stepchild, or foster child, meaning they've basically got to be a qualifying child. Now, with head of household, in an instance where you are actually unmarried, you can have qualifying relatives qualify you for the head of household filing status. But if you are technically legally married, you won't be able to do it unless you have a qualifying child at home. We'll show you an example of that in a little bit. And then you have to be able to claim an exemption for that child. Okay. Now, if the taxpayer is actually unmarried, when we look at our qualifying person, it does not have to be a child. It can also be a qualifying relative, but they have to be related to you by blood or by marriage in order to be a qualifying person for this filing status. The taxpayer has to live in the home with that qualifying person, with the one exception to that being that if the parent is the qualifying relative, the parent does not have to live with the taxpayer. They can live in their own home, and then the taxpayer would have to pay more than half the cost of keeping up that parent's home. But again, if you're considered unmarried, your parent is not going to get you to qualify. And again, we'll show you an example of that in a little bit. Okay, so first example here, page 2 of your book, separated Susie lived apart from her husband for 5 whopping years, but they do not have any sort of a legal separation agreement and there's no divorce. I will tell you, this is it's like scary common. I have a friend of mine who got married when she was really young, and then her and her spouse, they just decided, hey, we're going to go off and do our own things. But neither of them had the money to go through or, thought to go through the divorce process or the legal separation process. And so even though they've been apart for 7 or 8 years, they're still legally married. They're still on the books that way. Okay. So that's what's happening with Susie here. Susie's mother qualifies as her dependent. Susie's mother would not obviously be a qualifying child. Susie's mother would be a qualifying relative. Susie pays all the costs of maintaining the household, and the question is, can Susie use the head of household filing status? And the answer, unfortunately, is no. Now, if Susie was legally, separated, or there was a divorce decree that went through, then Susie would be eligible for the head of household filing status. But because she is still technically married, for considered unmarried, it's got to be a qualifying child. It cannot be a qualifying relative. So she will not get the head of household filing status. Okay, there is a taxpayer identification number requirement, obviously, as most things in the code do. So you got to have either an SSN or an ITIN in order to be eligible. But keep in mind, again, you cannot be a non-resident alien at any time during the taxable year. Okay. Now, when we talk about, paying more than half the cost of keeping up the home, we've got to consider like, what's counted in that, right? And one of the big things that we tend to look at when we're looking at paying for more than half of the cost of keeping up the home is what is the cost of the actual home itself? Because oftentimes that's a very large expense relative to the food that you might pay for or the cost of utilities and things like that. Now, under the old rules and the old final regs, you cannot consider the rental value of the taxpayer's home that they own. Okay, you could only look at the property taxes and the mortgage interest and the utilities and things like that. But in 2018, the IRS dropped proposed regulations and they said, look, if you want to, you can apply these proposed regulations and you can look at the fair rental value of the home as though it is something that you are paying for when making this determination, which just makes it easier to be able to qualify. You don't have to do anything special to apply the proposed regulations. You just take that position on the return. So in our example here, we've got dad. Oh, actually, before we do our example, we have our first poll question. Are you here? Yes, I am. Are we good on questions, Emily?
Yes, good to go.
Great. Okay, cool. So in our example here, we've got dad who inherited a home from his parents. So there's no mortgage on it, but he does have to pay property taxes of a whoppingly tiny $3,000 a year. I wish that my property taxes were that low. Mom lives with dad and their child, but mom and dad are not married. Mom pays $1,000 a month for food and utility costs. And then dad makes $150,000 a year and mom makes $20,000 a year. So the question is, who can use the head of household filing status? Now, if we just apply the old rules, we look to see, okay, well, who paid what? Well, dad paid $3,000 for the year and the cost of keeping up the home, and mom paid $1,000 a month, which is $12,000 for the year. And so if you just apply the old rules and you don't apply the proposed regulations, mom is going to be the one that pays more than half the cost of keeping up the home. And so mom would be the only one who would be eligible for the head of household filing status, which is silly because mom only makes 20 grand. We would much rather apply the head of household filing status to dad because it's going to save us far more in tax with the larger standard deduction and also the wider rates. Okay. So what we can do is we can apply the proposed regulations and we can look at what is the fair rental value of the home that they live in. And so as long as we can show that the fair market rental value of that home is more than $12,000 a year, meaning more than what mom paid for food and utilities, then dad could be treated as though he paid more than half the cost of keeping up the home, and thus dad would be eligible for the head of household filing status. Okay. So you just got to make sure that you're aware of these different rules and different ways that you can do these calculations, because sometimes it's going to work out better one way than it is the other. Okay. Two households in a single residence. Now, this is not really something that's new, but I find that some people either overlook it or they aren't as familiar with it. So this rule basically says, look, if you've got a couple of families living under one roof, for the purposes of the head of household filing status and determining whether you paid more than half the cost of keeping up the home, you can basically chop that home into smaller segments. In the proposed regs and also in the court case that this came from, they basically divided it in half. Now, In order to be able to do this, the taxpayers cannot be married. You can't have a spouse, the other spouse, in the same residence. And you also cannot split this up if another individual in the other household within the same residence could claim or have priority to claim the dependent of the first taxpayer. And I will show you an example of this in a minute so it makes a little bit more sense. So in this example, we've got mom and dad. They are not married, but they have 4 children together. This is one of the people I talked about where they just said, we're not getting married, but we'll have 4 kids together. All 6 of them live in the same residence for the entire year. Both contribute to expenses, but mom has a higher AGI. Can both be head of household? So you might look at this and say, well, why can't I just give 2 kids to mom and 2 kids to dad and cut the household in half and let them both be head of household? Well, the problem is that they have 4 kids together, okay? And so what we have to check to see is if we split the household up, would the other member of the household have priority to claim those kids? And in this particular instance, because mom has a higher AGI, when you get into these fights about, hey, who gets to claim the kid, the tiebreaker rules would say if the kids live with both parents equally throughout the whole year, it goes to the parent with the higher AGI, which would be mom. So in this particular case, even though they don't have to fight over it and they could assign 2 kids to dad, mom is the only one who can be the head of household in this example. Okay, what if we've got 2 sisters in the same house? Okay, so we've got 2 sisters. They each have their own kids from separate relationships, obviously. Okay, hopefully. Neither sister can claim the other as a dependent. Each pays more than half the cost of keeping up the expenses for themselves and their child. Each claims their own child as a dependent. Can both sisters be head of household? Now, here, we take the residence, we chop it in half, and we say, does the first sister have priority to claim the second sister's kid? And the answer is no, because the tiebreaker rules would default to whoever is the parent. And so because the tiebreaker rules don't cause that issue with priority to claim, each sister can be treated as though they maintain their separate household, and each sister can be head of household even though they live under the same roof. Okay, single parents, single mom and single dad live together all year. Each has their own child. They don't have any children together. Neither may claim the other as a dependent, and neither can claim the other's child. Each pays more than half the cost of expenses for themselves and their own kid, can both be head of household. Well, again, here, because mom and dad have children from separate relationships, neither mom nor dad would have priority to claim the other's child. And so for that reason, you can split up the residence into 2 separate households and both can get the head of household filing status. But this goes out the window if they have a child from a separate relationship, but then they both have a child together, because now you'd start to have this priority issue and it may shift to where only one parent is actually eligible for the head of household filing status. So it would just depend on, some more facts and circumstances, what's mom and dad's income, etc. Okay, next up, we've got a multi-generational household. Let me see how we're doing on time here. We're doing okay. And we'll push past this section in just a minute. We've got grandparent, parent, and the parent's 2 children. So all 3 generations living together in the same house. The children are qualifying children of both the parent and the grandparent. The grandparent pays $2,000 a month in property tax and interest. The parent pays $1,600 a month in food and utilities, and the grandparent pays $500 a month in food and utilities. Neither claims the other as a dependent as far as the parent and the grandparent. And the question is who can use the head of household filing status. Now, mom or the parent is always going to have priority to claim the 2 grandchildren, basically. But the problem is that we got to make sure that the parent is paying more than half the cost of keeping up the home. And so if you don't split up the residence, grandma's going to pay 2,500 a month, but the parent's only going to pay 1,600 a month. And so under that circumstance, you would say, no, sorry, the parent cannot be treated as though they maintained a separate household because they didn't pay more than half the cost of keeping up the home. Now, the good thing here is that the parent has priority to claim the kids. And so if you can chop up that home and say, look, the parent and the two children lived in two different rooms, and then the grandparent lived in one room, you can split up the house that way, and you can kind of reallocate how those expenses are being covered. And maybe we could reduce the grandparents' contribution to only being $1,000 a month instead of being $2,500 a month, which would allow the parent to qualify for the head of household filing status, even though if you look at the entire residence, technically the grandparent pays more. So these are all just things that you want to be aware of and thinking about. Okay, in your book on page 6, I have this really wonderful chart. Before we go into that, we've got a poll question. Are you currently in New York State? I am not. Do we have any questions?
Yes, there was one question. Colleen asks, regarding prior example, mom can be head of household with 2 children. Dad can be single with the other 2, as long as dad pays more for the other 2 children's support.
So I'm trying to remember which example it was that we were looking at. If they're all shared children, the answer would be no, because one of those parents is going to have priority based on their adjusted gross income. So
Okay, so it applies to all children that the 2 parents
that they have together. Now, let's say that mom and dad, they've got one child each from separate relationships, and then they have 2 shared children. You might be able to get head of household for each of them because they have each their own children from separate relationships, even though they have, combined children from their relationship. So the big thing is it all shared children, or do each of them have children from separate relationships? Okay.
Okay, and then actually a quick question with that is, like, if the mom, so you can't split, can you split the kids up for the child tax credit though?
Yeah, absolutely. Absolutely. Yeah, the kids can be split up for the credits and things like that. So long as you don't have any like tiebreaker issues that you're gonna deal with, which likely you wouldn't, and both of them would likely be considered the custodial parent anyway. So so it'll be fine for them. But yeah, the problem that you run into here is when you've got kids from the same relationship with the person that you're living with.
Right, one person can do head of household, but the other one cannot. She says now, what if they sign a support agreement? But I think they were married, so you don't have to.
See it, and it doesn't change it. It's you always look to when you're trying to break up a single residence into 2 separate households, you always have to look to the tiebreaker rules. And so having like a support agreement does not change that. Okay, so over on page 6 in your book, I have it looks way better in your book than it does here on the PowerPoint, but this is just for your reference. I've got the rules for qualifying child versus qualifying relative. We'll go through a couple of them here, but just so that way you have a reference. The key thing to point out is that for a qualifying relative, if their income exceeds that $5,300 number for 2026, then they're not going to be eligible to be a qualifying relative on the return. Okay. So for the support test, this is another difference between qualifying child and qualifying relative. For a qualifying child, the dependent cannot provide more than half of their own support, but for a qualifying relative, it's the taxpayer who has to provide more than half of that dependent's support. Now, you can have support agreements here, and that may change the ultimate treatment, but I'm not going to go too deep down that rabbit hole. Okay. Now, what is included in support? So that's going to be, your standard stuff, which is like, hey, where do we live? How much is the cost of lodging, food, clothing, your medical expenses, education, but not if it's paid for via a scholarship. Scholarships are excluded from the support calculation. They're not support of the child or support of the parent. They're just disregarded. Some gifts and entertainment items can be considered support. Medical insurance proceeds are not support. And then there are a few other like public benefit items and insurance items that are also not considered to be support. Okay. So again, as a reminder, scholarships and the tuition paid for by the scholarships are not treated as support for this calculation. Also, if you've got a child who is away at school, one of the strategies might be to consider the fair market value of the child's room in the parent's home in the total cost of support. Because presumably, when the child is done with the semester, they're going to come back home, they're going to need a room to stay in, and so you can't just rent it out. So you count the fair market value of their room in that support calculation to help the parent if they need it. So we got a couple examples here. We'll just go through them real quick. Randy is 19. He earned $5,100, which is under the gross income limitation for qualifying relative, but that's not going to matter here because he is a student. Okay, so as long as he's under 24, we're good to go there. He got $40,000 in the form of a scholarship that was used to pay his tuition. He spent all of his earnings, all of his $5,000 on rent, gas, groceries, and entertainment. Now that is all support, but it's only $5,100. The parents pay insurance on Randy's car of $1,500. They pay $800 for gifts, $3,000 for vacation, and $500 for food. Now, if I was better at math, I could do this for you off the top of my head, but I've got to look at the answer slide because I'm not that good. Again, the scholarship and the tuition that it paid are ignored for this calculation. So Randy only paid $5,100 of his own support. But when you total up all of the parents' support, they're at $5,800, bringing total support to $10,800. So in this particular example, Randy is not providing more than half of his own support. Now, I could imagine a world where Randy makes more than $5,100. Maybe Randy made $7,000 or $8,000. And if that was the case, then Randy would have paid for more than half of his own support and he wouldn't be a qualifying child. And so what would we do? Well, we didn't consider the fair market value of the room that we kept for Randy. So that way, when he was done with college, he could come back home and have somewhere to sleep, right? So there are games that we can play here with the support calculation to push it one way or another, depending on what it is that we need to do. Now, if grandma paid the tuition, then that tuition would be counted in the support calculation, but it wouldn't be counted for Randy. It would be paid by grandma of $50,800, right? That's what the total support would increase up to. Now, even though grandma paid the vast majority of Randy's support, it doesn't matter. The only thing that matters for the qualifying child test is making sure that the child did not pay more than half of their own support. Okay. What about 529 funds that are used to pay for college? Oh my gosh, this is an age-old question. People have argued it every single way. And to be honest with you, it's vague and the IRS refuses to provide an answer to it. So there are two kind of reasonable interpretations to take here. Now, let's say, I got a good example for you. My mom set up a 529 plan fund for me when I was growing up. They thought I was going to go to some fancy school. I ended up going to a state school, saved a bunch of money. It was great. And so the question is, when the 529 pays the tuition, who is that treated as though it's support for, right? Well, it's my 529 account. And so if the funds go to pay for my college, I would think that I'm providing that own support because that's my account. But here's the thing. I'm not the custodian of my own 529 plan. My mom was the custodian of the 529 plan. And my mom is ultimately the one who has control over the account at the end of the day. She could choose to pull that money out and go on a really fancy vacation or buy a really fancy new car. So there is a reasonable interpretation to pivot it either way, depending on what you need that support number to show. Okay, in our next example here on page 9, we've got Ashley, who is 20 years old. She made $10,000, which she spent on her own support, $5,000 in tuition, and $5,000 on miscellaneous rent, gas, groceries, etc. The parents also pay insurance on Ashley's car of $1,500, $800 on gifts, $3,000 on vacation, and $500 for food. So the question here again is, can the parents claim a dependency credit? And here, unfortunately, again, Ashley in this particular case is going to have paid more. She paid $10,000 compared to her parents' $5,800. But again, we look to see what other items can we bring in here, the fair market value of Ashley's room at home, and that might allow the parents to say, hey, we did provide more than half of your support. And so that would allow the parents to get the dependency credit. Okay, so over on page 9, what if we have a qualifying child of multiple taxpayers? So again, sometimes it can go either way here. Typically, if the parents can agree, you can shift the child over, but we have all of these different tax benefits that are potentially at stake. Now, we don't really have the exemption amount anymore. That was suspended under the Tax Cuts and Jobs Act, and that was permanently suspended under the One Big Beautiful Bill Act. But we've still got child tax credit or other dependent credit. We've got the head of household filing status, child and dependent care credit, exclusion for dependent care benefits, earned income tax credit, and certain education credits. Okay. So the question is, if I'm the custodial parent and I want to let the non-custodial parent claim the child, what am I allowed to basically give them of these benefits? Now, if you have two people who try to claim the same child, we're going to have to deal with the tiebreaker rules. So, under the tiebreaker rules, if only one of the people who attempted to claim the child was the parent, then that parent wins regardless of basically everything else. If both people who attempted to claim the child are the parents of the child and they lived with the taxpayer the same amount of time during the year, each taxpayer the same amount of time during the year, it goes to the person with the higher AGI. But ultimately, they look to where is the time spent. And so if the child spends more time with mom, even if mom makes less money because the child spent more time with mom, mom has priority to claim. Now, we were talking actually before the call about, well, what happens when mom and dad both claim the child on the return? Well, if dad files first, mom's return, when you go to e-file it, if you try to claim the kid, is going to reject. Now, prior to a couple of years ago, that would mean that you would have to paper file mom's return. But that changed about 2 years ago. So there's now a thing that says, look, if you file your return and you try to claim a dependent and that dependent was already claimed by somebody else, you can go onto the IRS website and get an IP pin for the parent, for the actual taxpayer. And when you put that IP pin on the return with the double claim dependent, it will still e-file. Okay, so just in case you weren't aware of that, something to think about and be aware of. If no parent is trying to claim the child, so you've got two people, maybe like a grandma and an aunt that are trying to claim the same child, it goes to the person with the highest AGI. And if a parent can claim the child but does not, then again, you look to AGI. Okay. So as far as, hey, what benefits can be pushed if we're going to let the non-custodial parent claim the kid? So the only things that the non-custodial parent can get are the actual exemption for the child, which doesn't exist anymore, the child tax credit or dependent credit, and education credits. But even when that kid is assigned away, the custodial parent, the one where the child lives with them the majority of the year, they're going to be entitled still to the head of household filing status, child dependent care credit, and the exclusion for child independent care benefits and earned income tax credit. That stuff cannot be shifted away to the non-custodial parent. So something to be aware of. The divorce decree does not override the IRS rules. So there is no way that you can push those custodial benefits over to the non-custodial parent. But there are often times where the courts will say, hey, the non-custodial parent gets to claim the kid on their return. And here's the thing. If you don't execute an 8332 and both parents try to claim, the IRS is just going to go to the tiebreaker rules. They don't care about the divorce decree. And so I've gotten, in the last 24 hours, two horror stories on this. I had one person who emailed me and said, hey, I had a client where they basically, didn't sign the kid over, and the judge said they would hold him in contempt. And then I just heard before the call somebody say, I have a client who ignored the judge ordering them to amend their return to give up the kid. The taxpayer didn't do it and was, held in contempt of court and had to go to jail overnight. So these are all things that you got to think about when you're talking about family drama. Okay. Alrighty. Now, this is basically what we talked about before. This example goes over the tiebreaker rules. We got to keep moving here because there's a ton of stuff that I want to cover. And if we spend too much time on the basic things, then we're not going to get there. Okay. So you're all in New York, and I believe in New York, you don't have community property rules. But we are going to spend some time in the session today talking about community property because I'm sure that many of you do have clients who live out of state and they are subject to community property rules. And I know some of those rules are very weird. So here's a little taste at what that's going to be like. So we have parents who lived with their son in California, which is a community property state. The son paid all of the mortgage, utilities, and the food. Mom, so grandma, basically, earned $12,000 working a part-time job. She was a greeter at Walmart, and the father had no income. So the question is, can son claim them as dependents? Now, if this was in New York, the answer would be that the son could claim the father because the father would be a qualifying relative, okay? And then you could potentially do the head of household filing status there. The problem is that in a community property state, all of this income has to be split in half and is treated as though half of it, 6,000, is earned by mom and half of it, 6,000, is earned by the father. And so as a result, that's going to be over the $5,300 limit for 2026 for a qualifying relative. And so in California, this son would not be able to claim the parents and they would not be able to use the head of household filing status. Okay, so you just got to watch out for community property rules when you have these odd situations that pop up. Okay, in our next example here, we've got mom and baby Jane who live with grandma all year. Mom is 25 and unmarried. Her AGI is $9,000. Grandma's AGI is $15,000. Jane's father did not live with mom or Jane, and the question is who can claim Jane, the baby? Okay. So, because Jane is a qualifying child of both mom and grandma, mom can let grandma claim Jane, and then grandma could qualify for all of the 7 benefits, provided that she paid more than half the cost of keeping up the home for that year. Okay, we just went through this. Now, if mom's AGI is higher, there's a reverse to that tiebreaker rule. And so grandma would not be able to claim the grandchild if mom's AGI is higher. Okay. So let's talk about splitting some qualifying children here. What if mom also has 2 other young children? All 3 are qualifying children of both mom and grandma. Okay. So you can shift up the kids as long as grandma's AGI is higher. Mom can let grandma claim more of the kids, 1 or more of them. But grandma will not be able to get the head of household filing status because you won't be able to split the residence in 2 because under the tiebreaker rules, mom would have priority to claim those kids. Okay. What if mom is only 18 years old and did not provide more than half of her own support? Well, mom could still be grandma's qualifying child. And so if someone is a dependent of another, they cannot claim dependents of their own. And so grandma would end up claiming all of them on the return. Okay. So in the next example, we've got mom and dad are married. They live with their daughter Jane and with grandma. Mom and dad's joint AGI is $20,000 and grandma's is $15,000. Can grandma claim Jane? Now, we talked earlier about when you have a parent and you've got another who is not a parent trying to claim the child, you will have a problem if the parent's AGI is higher, which is what's happening here. However, because they're filing a joint return, you can split up that AGI equally between either parent, and this can allow grandma to still have a higher AGI to satisfy the fourth tiebreaker rule. Okay, let me see here. I want to see if we want to keep going on this particular topic. Oh, we have a poll question. Are you still with us? Yes, I am. And do we have any questions?
Yes, Frank Deegan asked, there was a discussion on the Drake board about quote unquote younger, and then in the case of twins, is one younger than the other for dependency standards?
I'm not sure about that. I'm not, I'd have to do some reading on that.
Okay, thank you.
Hmm.
Hey, Ryan, it's
Yes.
Phyllis. I just looked up, and this wasn't in a context, but I did a quick search about, who's considered older for twins. And, at least what I found online said that the older one is the one who was delivered first. So I guess the younger one would be the
Yeah,
one who's delivered second.
I feel like I've heard about that in this context, but I don't recall off tops, and I don't want to make a comment about it without being certain.
Cool. Thanks.
Okie doke. Yep. So we've got some more examples in here about, hey, timing can be an issue because if you've got the parents, remember that the child in the tiebreaker rule is going to go to the parent that they spent the most amount of time with. However, if it was equal, then you look to the parent who has the higher AGI in a tiebreaker situation. Okay. So let's do another example here over on page 14. We've got no ring mom and won't commit dad. They have a 5-year-old son together, and they live together all year. Mom and dad are not married. Mom's AGI is 12,000 and dad's AGI is 14,000. Who can claim the son? Well, again, if they both attempt to claim, what's going to happen is the tiebreaker rules would say that it's going to go to the parent with the higher AGI. However, they can simply agree that mom or dad will claim the child. So if they agree, you're all good. If they disagree because mom's getting upset, the dad's not proposing, then, they'd have a fight about it and it'd go to whoever has the higher AGI. Okay. Which is basically what this goes into here in this example. Okay. Let me see. Do we want to go over this one? Yeah, sure. So in this next example, we've got a 25-year-old auntie, a 7-year-old niece, and grandma who all live together in the same property or in the same home. Okay. Auntie's AGI is 9,300 and grandma's AGI is $15,000. The niece's parents filed jointly with 9,000 of AGI and they do not live in the home. Who can claim the niece? Well, here, the niece could be the qualifying child of both auntie and grandma, not the qualifying child of the parents because they didn't live with them for at least 6 months during the year. And so only grandma would end up claiming her because she's got the higher AGI if there's a situation where they both attempt to claim her. Okay. This example basically goes over who gets what benefits, which is what we went over earlier when we looked at, hey, what can be assigned to the non-custodial parent in an 8332 situation. Again, we want to get into some of the deeper stuff that's happening a little bit later in the class, and there's so many examples in here, so I'm going to jump over this one. Okay. Hold on one second here. So really quickly, let's talk about due diligence because a lot of the tax benefits that we're going to talk about in the session today are subject to the additional due diligence requirements. And so if you've got a taxpayer who's going to claim something like had a household filing status or earned income tax credit or child tax credit, remember that they've got to file that additional form. And the failure to do due diligence would result in a $665 penalty per failure. Note that there are 4 potential failures on a return, bringing the total penalty in an instance where all of those benefits were claimed to a potential $2,400 for that single tax return or more. So you just got to be aware of that. We have a whole due diligence checklist on our website under the Practice Aids tab. Okay, let's get into the adoption credit. This is kind of a wonky one. There's lots of weird rules because we have both a credit and an exemption. So before we do that, we've got a poll question popping up here. Have you ever attended the NYSSEA annual conference? Yes, I have. And are we doing okay on questions?
Yep, doing fine. Thank you.
No problem. Okay, so for adoption, the thing that you want to know generally before getting into this section is that, hey, if you adopt a child, they are your child for tax purposes, okay? And really that distinction of adoption really comes into play when we're looking at, the credits and the potential exclusion that they might be eligible for. In order to be placed for adoption, doesn't have to be done by an agency or by a court. And you can have biological parents or state authorized persons who, basically could take custody of the adopted child, but not go through and finish all of the legal paperwork, and it's still okay. Uh, the taxpayer, or sorry, the adopted child needs to live with the taxpayer for more than half of the time the child was alive for that year. So I have an example on that. Yolanda Youngmother takes her baby home from the hospital. A month later, she decides to give the baby up for adoption. And in October, the baby is placed with the taxpayers, but not by agency, not by an agency or by the court, which is still fine. We can still say, hey, the adoption's done once the kid is in the home. And the question is, can the taxpayers take the dependency exemption? So yes, as long as the adopted child lived with the taxpayer for more than half of their life, which started, towards the end of that year. Okay, so child living with taxpayer who's not lawfully placed, the child may have to meet the qualifying relative tests if that is the case instead of the qualifying child test. So that's just something to be aware of. So let's go over this example with no adoption proceedings. We've got young mother who had the baby live with her friend Franny. The friend did not begin adoption proceedings. Can the friend claim the dependency exemption? So no, because the child here was not placed for adoption, right? So the child has to be placed for adoption, but it can still be before all of that paperwork is finalized. And here you would have to have the parent have the child meet the qualifying relative tests, which includes that the potential qualifying relative lived with the taxpayer for the entire year instead of simply more than half of the year or half of their life. Okay, let's jump into the adoption credit. So this is on page 17 of your book. Now, we've had some really cool changes to the adoption credit this year. Our maximum credit is increased up to $17,670. This is not a per year limit. This is a limit per adoption. So if you adopt 3 kids in a given year, then you would get 3 times the $17,600 maximum credit amount. Now, obviously, you have to incur expenses in most cases in order to be eligible for that. However, I will show you that there are instances where even if you don't pay anything, you can still qualify for the maximum credit amount. The maximum employer provided exclusion is also $17,670. The taxpayer can use both, but they cannot use the same expenses for both. The refundable portion of the credit, right? It used to be zero, but now for 2026, actually it's for 25, I believe, and for all future years, up to $5,120 of the credit will be refundable. So this is a really great change that they've made. I've seen many instances where taxpayers will adopt a child. Maybe it's a special needs child. They end up getting the full maximum credit, and then they're really waiting a long time to be able to use all of it up. And it can only carry forward up to 5 years. So that is something you've got to be aware of. Okay. So there is an income phase out for both the credit and the exclusion that starts at about $265,000 and tops out at about $305,000. The applied year for the credit, as far as when you're applying the phase out, is the year that the credit is generated, and it's not reapplied for carryover years. I'll show you an example of what that means in just a little bit. Again, it's a per child credit. So each potential child could get up to the full potential limit. All years are combined per adoption effort. Okay. And again, I'll show you an example of what that means because it's different for a US child than it is for a foreign child. So for a US child, if you make an unsuccessful attempt to adopt a US child, you get the credit in the year after you pay the expenses. So I'll show you an example of that. In a foreign adoption, you do not get the credit until the adoption is finalized. So it might take multiple years to be able to adopt one of those children. And so you may have to wait. You still get a credit for those expenses from a couple of years ago, but it's all one attempt. And again, with the foreign child, you are waiting until the year the adoption is actually finalized. Okay. Alrighty, so in our example here over on page 18, we've got Pat and Sam who are life partners, but they are not married. They had a failed attempt at an adoption and they paid $6,000 of attorney's fees and $10,000 to a surrogate. They had a successful adoption attempt of a different child. For that, they spent $6,000 on travel, $6,000 on attorney fees, $900 on the court costs, and then $13,000 to fence a pool, which was required by that state when adopting a child. If you had a pool, you got to put a fence around it. Pat's income is $310,000 and Sam's income is $150,000. Both of their employers offer adoption assistance as a fringe benefit. So who's going to get what? Now, it all is going to come down in this particular instance to who pays for what. So if Pat pays all of it, then those expenses all are applied on Sam's behalf or on Pat's behalf. If Sam pays all of it, everything's applied on Sam's behalf. The problem is their income. So Pat's income is way over the end of the phase out range. And so Pat wouldn't be eligible for the credit or for the exclusion. But Sam, he's way under the threshold. And so ideally, Sam is going to pay for those costs, and then Sam would be entitled to both potentially the credit and to the exclusion for any benefits provided by the employer. Now, what expenses are qualifying or not qualifying? So a qualifying expense would be your actual cost of your adoption fees, your court costs, attorneys, travel, reasonable expenses, and also necessary state required expenses, like the $13,000 pool fence. That would all theoretically get reimbursed through the adoption credit, so long as it was required by the state, and it will be a great benefit to them. Now, non-qualified expenses, if you violate state or local law, if you bribe, a person to be able to adopt a kid, that's not going to be an eligible expense. Surrogate parenting arrangements are not qualified for expenses that can be considered for the credit or the exclusion. And then again, you can't share the expenses. So if I only have 10,000 of expenses, I can either do the exclusion, or if they were reimbursed through my employer, I can get the exclusion there. So it's got to be one or the other for a given expense. Okay. So as far as Sam's qualifying expenses, remember we were going to have him pay for all these costs. The attorney's fees for both attempts would be okay. even though it was unsuccessful for the US child, and the travel costs, the court costs, and the cost of the $13,000 fence would also be eligible. When you total all of those items up, that's about $31,900, and you can divide it any way you want. I would prefer to do more of it as credit, and then get the rest of it as the employer exclusion. But again, you can do it whichever way you want to. Obviously, it's going to depend on what other tax credits the taxpayer has on their return. Okay, you can get the maximum $17,000 credit and exclusion even if you don't incur any expenses. Now, this will apply when you are adopting a special needs child. Now, the definition of a special needs child is generally going to vary from state to state. In California, it's very broad. Okay. So if they've got, a learning deficiency, if they have some sort of a disability, those would be special needs children. If you're adopting from a family member, that can be considered a special needs child. Okay. So the bar is going to change based on your state. So you will have to do some research for New York, per se, to check to see, hey, is this a special needs adoption or is it not? There are some key factors that you can look at that I have listed in your book, but for some reason they are not in the slides. If you ask the taxpayer about their recent adoption experience and they say, I didn't really have to pay anything because the state paid all of my costs, that's usually a really strong indicator that it's a special needs child. Okay, so that's something to look into. Okay, so what if Pat and Sam, before we do this example, we've got another poll question. Are you a member of NYSSEA? We doing okay on questions?
All good. Yep. Thanks.
Okay, so what if Pat and Sam said that they had no costs? Again, this would be an indicator that it's potentially a special needs child, which means they could be eligible for the entire $17,600 credit, even with no costs. Now, while they may be eligible for the employer provided exclusion for adoption, oftentimes employers will not pay out to the taxpayer unless they actually incurred costs. So while it's great that you didn't have to pay anything, you're only really usually in real life going to get the actual credit, and you won't end up getting the exclusion because the employer won't reimburse you for expenses you did not incur. Okay. Oh, I do have a slide about this. So again, some of the indicators are very low or no costs when you're going through the adoption process. If they're getting financial assistance from the state following the adoption, that's a good indicator. And then again, family member adoption are often for special needs. Okay, so when are you going to claim the credit or the exclusion? So for the credit, you're either going to claim the credit for a U.S. child that you attempt to adopt in the earlier of the year after you made the payments or the year the adoption was made final. So if you're a lucky person and you started adoption proceedings in 2026, and by the end of the year you adopted the child, then you would get the credit on your 2026 return. But if you attempted to adopt a U.S. child and you paid for expenses in 2026, but then the adoption didn't finalize until 2027 or 2028, your expenses you paid in 2026 would not be eligible for the credit until 2027, which would be the year after they were paid. Okay. But again, if you finalize the adoption, bam, that's the year that you get the expenses or the remainder of the expenses. Now, when you're talking about the credit for the foreign child, the credit is only allowed when the adoption is made final. So it might take 3 years that you're paying expenses to attempt to adopt a foreign child. You're going to keep all of those expenses in a folder, and then when the adoption is finalized, you'll add all of those up for that year and the prior years for that attempt, and that's when you would get the credit. As far as the exclusion is concerned, again, if it's a U.S. child, you get the exclusion in the year that the payments are received, regardless of whether or not it's finalized. For a foreign child, you're going to get it in the year the adoption becomes final. Okay, so let's do a quick example here. We have a taxpayer who makes a first attempt to adopt a US child in 2024, and then they make a second attempt to adopt a foreign child. They paid some expenses in 2025 and it finalized in 2026. So the question is, when do they get the credit and the exclusion? Now, for the exclusion, if they received amounts for the US child that they attempted to adopt in 2024, the exclusion would just apply in 2024. If they paid expenses for the first attempt to adopt a US child, but it didn't finalize, then those expenses would be allowed for a credit, but they wouldn't get the credit until they filed their next year return, which would be their 2025 return. For the foreign child, even though they paid expenses in 2025 and maybe they received some assistance from their employer, they're not going to get those benefits until you look to their 2026 return because that's when it was finalized. Okay, in your book, there's some information about penalty-free birth or adoption distributions. This was a new, retirement plan withdrawal provision that basically said, hey, if you've got a child that you either birthed or adopted, within that first year, you can pull up to $5,000 out of your retirement account. That is per individual. So mom could pull 5,000 and dad could pull 5,000. That is totally fine, as long as it's coming from their own respective accounts. You do have the option to repay that within a 3-year period. I'm not going to go through all the examples. Most people are already familiar with this, but it is in your book just in case you want to give it a reference a little bit later. Okay, let's see here. This is more on the birth or adoption distribution. Let's go ahead and jump over to medical expenses. So this is going to appear on page 22 and 23 of your book. Before we get into that, we've got another poll question, which is, are you paying attention? Of course I am. Okay. So for our medical expenses, when we look to see, hey, what can be deducted on the return on Schedule A, we can consider the taxpayer, the spouse, their dependents, and also something that we like to call medical dependents, which is where you have a child who they're not a qualifying relative or a qualifying child because their income exceeds the gross income test. But if they meet all the other requirements for qualifying relative, and the only reason you don't claim them is that their income exceeds that threshold, you can still treat them as a dependent for the purposes of deducting medical expenses on Schedule A. So that is something to be aware of. When you are in a position where you're incurring pre-adoption medical expenses, so you've got a surrogacy or something like that, you can have a problem sometimes with deducting those expenses on Schedule A because the care is not for your dependent. We have a section in your book that talks about that a little bit, so just be aware of that. Okay, let's talk about some medical expense timing examples. So in our first example here on page 23, we've got Adam, who was Adam learned of an available 2-week-old baby. The baby came to live with Adam at 8 weeks old. The adoption finalized at 8 months. Adam pays these bills on his baby's first birthday. The mother's pre-birth and delivery medical expenses, they reimburse the agency for the baby's hospital care after birth, the baby's 6-week checkup, and the baby's 1-year checkup. And so the question is, hey, what of this can we deduct? Well, we're not going to get the mother's pre-birth expenses because the mother was not a dependent when those expenses were incurred. We also are not going to get the reimbursement to the placement agency because, the payments are going direct basically to the agency and not direct to the hospital. If they would have paid them directly to the hospital, then they may have been able to take a deduction for those amounts. The 6 week checkup, absolutely, because the baby was a dependent at that time. And then the same thing with the 1 year checkup, that would be deductible as well on Schedule A. Okay, adult child medical. So in this example, we've got Matt, who is 25. He lives all year with his mom. He makes $6,000 in 2026. And the question is, can mom use the head of household filing status? Well, if Matt was a qualifying relative, then mom could use him to claim the head of household filing status. The problem is that Matt is too old to be a qualifying child, and it doesn't talk about him being at school or anything like that. And so now we look to the qualifying relative test. And so even though he meets all of the potential requirements, unfortunately, he does not meet the gross income test for qualifying relative, which says, hey, if your income is over $5,300 for 2026, you cannot be a qualifying relative. So for that reason, mom will not have him on the return as a qualifying relative. He will not be a qualifying person, and so she cannot use the head of household filing status. Okay. What if Matt only had $2,000 of income? Then he would be under that threshold and mom would be able to use the head of household filing status. Okay. We talked for a moment about the medical dependent situation. And so in our example here on page 24, we've got Theodore 30 is 30. He lives with his parents at home. He earned $6,000 working part-time, and his parents paid $8,000 of his medical bills. The question is, can the parents deduct? Now, the parents are not going to be able to claim Theodore on their return because his income is above the gross income limitation for qualifying relative. However, he can be considered, again, what we like to call a medical dependent. So that's where you meet all the qualifying relative tests except for the gross income test. And so they can actually still get a deduction for those $8,000 of medical bills. Okay, let's talk about the premium tax credit. Now, lots of political discussion about premium tax credit, a lot of changes that have been made in the last couple of years. I'm not going to dive too deep into those. What I want to focus on here is the family drama component of the premium tax credit. So there are these rules that basically say, hey, if you get your health insurance through your state marketplace, and your income exceeds 100% of the federal poverty line, but not more than 400% of the federal poverty line, then the federal government will give you either an advance subsidy to help cover the cost of your health insurance, or you'll be able to claim a credit on your return to effectively get that subsidy. And if you made more than the amount you reported to the exchange, you may have to pay some of that back when you go to file your return. Now, we are allowed to allocate these premiums out for different taxpayers. Now, let me give you an example here. So over on page 25 of your book, we've got dad and mom who have been divorced since January of 2015. They have two children, Dick and Jane. Dad enrolls himself and both of his children in the exchange plan. Jane lives with mom, and mom claims Jane as a dependent. Dad gets a 1095-A showing the policy amounts because he got the policy. If they don't have any allocation agreement, what is going to be the result? How do we do the policy allocations? So dad's going to be the only one that gets that 1095-A, right? And so what he would do on his return, if mom and dad did not agree to any special allocations, dad would say, okay, of the three people on this policy, myself and one of my children is claimed on my return, and then mom has the other child on her return. And so the default allocation would be to allocate a third of the premiums to mom. And so you would give mom the 1095-A and you would say, hey, you have to report a third of these. And we would put mom's social on the premium tax credit allocation form, and then dad's going to get the other 2/3 of the premiums allocated to him. That's the default method for premium tax credit allocations when you have a dependent included on a plan on another taxpayer's return, or somebody in that plan is on their own return or someone else's return. So the question here would be, well, what if dad is making $100,000 a year and mom is only making $40,000 a year? Now, if we just follow the default and we allocate 2/3 of the premiums to dad and 1/3 of the premiums to mom, dad is way over 400% of the federal poverty line. And so he would have to pay back all of his subsidy, or he wouldn't be eligible for any premium tax credit on his return at all. But the 1/3 that got allocated to mom might allow mom to claim some premium tax credit. So what can they do? If mom and dad don't absolutely hate each other, and even if they do, I would recommend trying to talk to them about this, is that mom and dad can come up with a deal and they can agree to allocate 100% of the premiums over to mom's return, even though mom didn't pay a dime of those premiums. Now, this sounds absurd. It sounds like it shouldn't be allowed, but the instructions tell you you are allowed to allocate in any way that the taxpayers agree. And so what we can do is we can, well, I don't have, of course, the example up here, but we could just say, hey, let's allocate all these premiums to mom's return. Mom will get a large premium tax credit and dad will shift all those premiums off. And so he won't have to do any repayment. And the family as a whole, even though they're divorced, will end up getting a larger amount of premium tax credit. So this is great if they can agree and do a little side deal and mom maybe reimburses dad at the end of the day. So here's another example, also on page 26. We've got a child that lives with their low-income parents. The family receives a large premium subsidy. In 2025, the child had very low income and they qualified as a dependent. But in 2026, the child gets a super high paying job and now they make $80,000. So how do we handle the premium assistance? So again, we have a situation where we've got the parents who have the health insurance policy and the child is technically on it and the parents get the 1095A, right? Now, by default, because the child is no longer a dependent, they're filing their own return. And so if they cannot agree, mom and dad and child, to allocate the premiums, then 1/3 of it has to go on the child's return, which means the child would have to pay back some of the additional subsidy and that the parents would get their portion on their return. Now, what we can do is we can get the two parents and the child to agree that all of that subsidy should be going on the parent's return because the parents are lower income. If the child has any of it allocated on their return, they'd have to pay all of it back or they wouldn't get any credit. So we get the greatest benefit here by including all of it on the parent's return. And again, as long as we have an agreement between all the parties involved, we're allowed to allocate in any way that we want to. Okay, here's another one. We've got a child who lives with their parents. The family received a large premium subsidy. In 2025, the parents had very low income, so they qualified for a lot of subsidy. But now in 2026, their income shoots up to over 100 grand. The child had income of $7,000. What's the best way to handle the premium assistance here? Now, in this particular case, again, we've got 3 people on the policy, the 2 parents and the kid. The kid has $7,000 of income. Now, we don't know if they're a student. We don't know what age they are. Let's assume that they're 25 and they're no longer in college. So that would be qualifying relative. And if we've got 7,000 of income, then they can't be a dependent. They'll file their own return. And what we can do is we can say, hey, because for 2026, the parents have super high income, we're going to allocate all of the premiums over to the child who only had $7,000 of income, and they will qualify for the full premium subsidy on their return. Okay. And again, this is just completed by filing the second page of the premium tax credit form. Okay. Alrighty, let's talk about unexpected income here for just a minute. In this example, we're going to say that we have a taxpayer that makes $30,000 a year, and every year they're getting $16,000 of advanced premium tax credit through that, subsidy basically up front. But this year, they got $80,000 of a lump sum Social Security disability back pay amount. Now, they used the lump sum election to report the Social Security on the return. How does the lump sum method affect the premium tax credit? Unfortunately, the answer is it doesn't. For the premium tax credit, we use a modified adjusted gross income calculation, which adds back all of your Social Security. And so, unfortunately, that's going to push the taxpayer to being over the 400% of the federal poverty line, and they're going to have to pay back all $16,000 of their advanced premium subsidy, which obviously is a terrible thing, but there's really nothing you can do about it unless somebody else maybe is on the policy and you can do a shifted policy allocation. In this example, we didn't have that. Okay, so there's some information in your book on the child and dependent care credit. We did have some changes to this credit in the last year where they increased the amount a little bit. Keep in mind that the custodial parent is the only one who gets to claim the child and dependent care credit, so you need to be considerate of that. Let's keep moving here. So in our first example, we've got kids who live with divorced Diane. The decree says that dad must pay the childcare costs while Diane works. Who gets the credit? Well, again, who is the custodial parent? Well, it's going to be Diane. But who pays for the childcare costs? Oh, that's dad, and he pays the childcare place directly. So, unfortunately, the non-custodial parent doesn't get the credit. Only the custodial parent does. And so in this case, no one's going to get the credit because dad's not eligible to claim the credit and Diane did not pay any expenses. Okay. Let's see here. Sometimes we can look at costs of maintaining the household to say that, hey, this is a part of the individual's care. And so if you're paying for a maid to come in and, clean up the kid's room, to cook or do domestic or other domestic activities, that may be eligible for the credit, which a lot of people aren't aware of. Some things that do not qualify, those would be something like a chauffeur or a gardener. But to keep up like the domestic part of the home where the kid needs to be, that could be eligible for this credit. Okay, in our example on page 27, we've got grandma who babysits baby Billy. The housekeeper cleans and does the laundry. And so the question is, are we going to get a credit for the amount paid to the housekeeper? Well, we can get a credit for the amount paid to the housekeeper. That's totally fine, even though she's not directly caring for Billy. Now, here's another interesting one. And I catch a lot of flack about this because, people say they want it to go one way or the other, but let's just go through the example here really quick. So let's say that we've got some grandparents who are receiving income for caring for their grandchild. People say that the grandparent should be reporting that income on Schedule C, which is in many cases not true. Again, for income to be reported on Schedule C, you'd have to show it's a trade or business, which means that they participated in the activity on a regular and continuous basis and that they had a primarily for-profit motive. Now, this literally came from IRS guidance, and they said, look, the grandparent who receives income for caring for their grandchild is not doing that primarily for profit. They're doing it because they're spending time with their grandkid, and the parents are often giving them money to effectively reimburse for some of the expenses that they might incur. Now, I could imagine a world where the grandparent hates their grandchild and they're just doing it for the money, but I don't think that that's most people, right? So if this is the case where we're going to say, hey, it's not primarily for profit, when the grandparent receives that income, they will report it in income, but it would go on Schedule 1, Line 8J, effectively as hobby income. And the parent would get to say that that is a qualifying dependent care cost, and they could claim a credit for the amounts paid to grandma. Um, we've got a grandma that babysits baby Billy. The mother pays grandma $3,000. How should grandma report the income? Again, Schedule 1, Line 8J, not subject to SE tax, but mom is going to get the credit on the $3,000 of costs, which often ends up being more than grandma's like income tax that she'll pay on the $3,000. So something to be considerate of. Okay, we've got another poll question here. Where are you right now? I am at my office. Do we have any questions or are we doing okay?
Yes, we had a question. Find it here. Um, going back to Pat and Sam, would Pat, with when one had higher income but was paying the expense, would Pat could Pat be considered gifting the money to Sam and then Sam paying them?
So, in an ideal world, Sam, the lower income one, would actually pay those expenses, and Pat would find other ways to basically kind of make up for those amounts coming out of pocket. The problem that I could see you running into is if the higher income person is just giving gifts direct, and then that money is immediately going out, that they could collapse the transaction and say, no, the lower income person didn't really pay it. It was the higher income person who paid it. So if you want like safety, I would have the lower income person pay it from their income and have the higher income person come up with other ways, to basically provide support. That would be a much safer way to get it done.
Great,
I
thank you.
have a question, Ryan.
Shoot it.
On the 1095A, where you talked about the allocation of
Hmm.
the expenses,
Yeah.
right? So, what I've come across in terms of that situation is when we remove the information from one taxpayer and then you transmit a return without the 1095A information, the IRS, the return gets rejected saying, we have determined that you had health insurance on the marketplace. And the
Hmm.
return will not be accepted by the IRS because the information isn't matching in their system. So, how do you get around that?
So did you go through and fill out the second page? I don't remember what the number of the form is. It the 8962? I think it is. I think it's the 8962. But if it's not, sorry. But it's the premium tax credit form. On the second page, there's a whole thing devoted to the allocation. And so you still fill out page one, but then it just gets allocated on page two.
Okay, maybe that's my problem.
Yeah, that's
Because
what you're
I'm,
missing. You can't just not file the 1095A for the taxpayer who gets the 1095A. They need to file that form still, but it's on the second page where you report the social of the other person that you're doing the allocation to.
oh, there you go. Thank you so much.
Yeah,
That's a step I missed.
no problem. No problem. Yeah, that's the thing to watch out for. If you have a childcare provider who refuses to give you their like ID number, whether it's their EIN or their social, you can still file the return without it, but you have to basically exercise due diligence. So you got to reach out, preferably by like email or text message or something like that, because you want to be able to document that you did in fact reach out. And then you'll just attach a statement to the return that says, hey, I tried to get this information, but they wouldn't give it to me. And I have the proof to show that I made attempts, that I did my due diligence, basically. But you could still get the credit. Okay, I'm not going to do that example because we got to keep moving here. Okay, in your book, there's a whole thing that talks about jointly owned property. So we've got these like different potential ways that property could be titled when you have multiple owners. There are a million different ways, and different states have their own different types of titles. The common ones are going to be tenants in common and then joint tenancy. Now, with tenants in common and with joint tenancy, what ends up happening is if one of the people dies in a joint tenancy situation, oftentimes that interest can be assigned out to somebody else, where in joint tenancy, typically everything stays within the owner set. And so you'll have these step up in basis items or issues that will occur on death, and you kind of got to understand like what's going to happen with that. Okay. So in our example on page 29, we've got deceased Dan and brother Bob who own land 50-50. Their cost basis in the land was $200,000. And we've got a fair market value on the date of death for Dan of $300,000. What if Dan leaves his half to his girlfriend Gail? So this was a tenant in common situation where Dan's interest would be assigned to his girlfriend at death. So what is Gail's basis on her half and what is Bob's basis after Dan's death? Well, Gail, because she's inheriting the property, she's going to get the step up in basis. The whole property is worth 300 grand. She only owns half of it. And so her basis would be 150,000 when she inherits it. But Bob, he is not affected by Dan's death for basis purposes. So his basis is going to remain at 100,000, which was one half of the $200,000 cost of the property. Okay. If Bob inherited Dan's share, he would keep his $100,000 basis in his original half of the property, which would be like a joint tenant situation. And then the part that he receives to become the full owner, that other half would get a stepped up basis to 150,000. So it's still not a full step up in basis on his entire interest. It's only a step up in basis on the portion that he inherited. Now, in community property states, I'm obviously a California return preparer, but there are, I think it's 9 community property states. You can have instances where both halves of a property are stepped up, even if they are, if they are community property. And so you've got, in California, taxpayer and spouse are married. They own the home and the home is community property. When one of the spouses dies, the surviving spouse, they'll get a step up in basis on the entire property, not just the share that they inherited. So that's kind of one of the benefits to community property is this big step up in basis that can occur at death. It won't just happen on the home. It'll happen on anything that's titled as community property, including investment accounts, rental properties, interest in partnerships, all of those different things. Okay. So in our example here, we've got husband and wife. They own stock as community property. Their basis in the stock is $75,000 and it's $90,000 for the fair market value when the husband dies. The wife inherits all of the stock. What is the wife's basis? Well, because they own the whole thing as community property, all of the stock gets a stepped up basis to $90,000 when the wife inherits it. Okay. So what if the son inherited H's half? What is the son's basis and what is the wife's basis? Okay. So instead of the wife getting the deceased husband's interest, it's going to go to the son. Now, half of it's still going to be included in the husband's estate. And so what's going to happen here is that the son's basis would be stepped up to his half of the fair market value on the date of death, which would be $45,000. But because it's community property, the wife will also get her step up, even though she didn't inherit her interest. So when you've got community property like that, one death of one of the spouses brings up the entire property when it's titled as community property. Okay, registered domestic partners. Now, in New York, I don't think you guys have registered domestic partners. I was doing some research before. It looks like some counties allow for some types of domestic partnerships, but it's not really the same as a registered domestic partner. And the treatment is really going to change state by state as far as what's going to happen with income and things like that. I'm going to focus here on California because that's where I'm from. And so that way you can kind of get an introduction into this concept of registered domestic partners. So in the state of California specifically, registered domestic partners are treated as married for state income tax purposes and unmarried for federal income tax purposes. Now, in every state that has RDPs, the feds do not recognize that as being married. So even if you have an RDP in another state, you know that for federal purposes, they are not married. And so they'll use the single filing status or the head of household filing status on their federal return. Okay. But on their state return, the states may vary. Again, in California, RDPs are married for California tax purposes. So it's just going to depend. Every state that has RDPs has their own rule about who can be an RDP. It used to be in California that RDPs had to be same-sex couples. But then they changed it a number of years ago to be opposite sex couples who were over the age of, I think, 65. And then they changed it again to same sex or opposite sex couples as long as they are over the age of 18. Okay. But again, it's going to vary by state. So every state's going to have their own rules for who can be RDP. Okay. So I kind of go over, hey, this is the difference for California and federal as far as what filing statuses would a registered domestic partner use. Again, on the Fed side, unmarried. On the state side, they are married. And so you're stuck with those potential options. Okay. Now, in California specifically, there are instances where I would tell couples not to get married and instead to be registered domestic partners because there are more tax benefits that are available to unmarried couples on the federal return, but you still get the benefit of doing community property income splitting potentially on both the federal return and the state return. Because in California specifically, registered domestic partners are eligible for community property treatment on both their income and the property that they own. The problem is that even though I tell people that they should become RDPs, that conversation doesn't normally go over very well between the couple. I have had a conversation with my girlfriend in the past about, hey, maybe the RDP thing would be better than getting married. And that resulted in crying and saying, why don't you want to marry me? And it was a whole thing. So just because it's better for tax purposes doesn't mean that the couple will actually go for it. But again, in California, I think registered domestic partner is the bee's knees. Here's a couple of reasons why. If you've got a couple who is going to become registered domestic partners, if you've got the high earner and that high earner has a kid from another marriage or another relationship, that taxpayer can get the head of household filing status. Their registered domestic partner would get single filing status, but then they would split the income, which actually ends up giving you better tax savings than married filing joint. So that is something to be considerate of. You can also have double heads of household if the taxpayer and their registered domestic partner both have kids from prior relationships, because then both of them can get the head of household filing status, which means, again, you get more benefit than if you were doing married filing joint. So that's something to think about. You also, by having registered domestic partners, because they're not married at the federal level, they're not related at the federal level, you can play tons of tricks with aggregation rules and related party rules and the rules for attributions. There are rules that say, hey, if I own two companies, one of my companies has a ton of employees and the other is just me. If I set up a retirement plan here, I got to set it up for my other company that has a ton of employees. And I may not want to do that. But if my registered domestic partner has a company, then they can set up a retirement plan and I don't have to set one up over here. So there are lots of interesting games that you can play with selling assets at a loss also between registered domestic partners. The capital loss limitation would be 6,000 because it would all be community income and loss for their capital gains and losses. So you get 6,000 instead of just the 3,000 for married filing joint. And you also get the benefit of unmarried mortgage interest, which I have at the end of this class. The disadvantage to being registered domestic partner as opposed to getting legally married is that you don't get tax-free marital transfers or gift splitting. There can be issues with real estate professional status, and then some states give registered domestic partners fewer rights. So in the state of California in particular, if you're an RDP, you are literally treated as married for basically every purpose, for insurance, for, medical issues, for financial issues, for all that stuff. In other states, it is not the same way. So even though I told my girlfriend that, hey, if we're RDPs, we're still married in California. And then she said, well, if we go to Florida, then we're not married anymore. And I said, well, I tried. I really did. So I think it's a cool strategy, but again, not everybody's going to go for it. We have our eighth polling question, which is, are you taking a vacation this summer? Yes, I just got back from Italy. It was fabulous. That was before we did our last week's session. Do we have any questions here, Emily?
Yes, we do. So Maria asks, if we do not have the Social Security of the babysitter, can we still e-file the return?
Yeah, you should still be able to e-file. I think that there's a checkbox if you had trouble getting the EIN. Otherwise, I would just toss in nines and I would attach the statement and e-file it, to be honest with you.
Great, thank you. And then Henry made the comment, community property is like Baskin Robbins, many different flavors depending on the state. I guess that's for all
Absolutely.
too.
Yes. So I actually have in here, because this class is like not that many pages, but there's so much content. Um, this kind of talks, there's more in your book about registered domestic partners. I would recommend giving it a read because it's just interesting stuff. I have a whole section in here on community property income splitting. This is a focus on California, but you're right. Other states have their own rules about what is community income, what is community property, and what is not. But I would say for the most part, in most states, when you've got, community property laws that apply, you got to do community property income splitting. Most forms of income will be subject to this if both the taxpayer and spouse are domiciled in a community property state. Now, this makes people really angry because they might be married, but they don't want to share any information with their spouse because what's mine is mine and what's yours is yours. And we're not going to combine our lives financially, but we're going to get married and lock ourselves together for infinity. And so they don't want to share their income, even though half should be reported on the taxpayer's return and the other half should be reported on the spouse's return. There are exceptions to community property income splitting on the federal return. So you can meet either or any of these three exceptions and you don't have to do the split, but it's not ideal. So the first exception is if the taxpayer and their spouse, where they're in a community property state, they live apart at all times during the year, they don't file jointly, and they have no earned income that transferred between the two of them, either directly or indirectly. I have examples of what that looks like in your book, but I'm not going to have time to go over all of it here today. Okay. But that's one to look at if you're wanting to get out of doing a community property income split. The second exception is if your spouse, for community property purposes, doesn't tell you about their income and doesn't give you any of the money and refuses to provide any documents before the due date of the return. If that is the case, you don't have to do the community property income split. Okay. The third exception is if injured spouse, innocent spouse, or equitable relief apply, which I've seen happen as well. So, it's the right thing to split the income, but you have these three exceptions. And I do have some examples in your book that show you how the exceptions apply. And when you have like tiny transfers between the taxpayer and their spouse, but they don't share income otherwise. But again, we don't have time to go through that. I just want to point out that there are tons of examples in the book. There's also a lot of information in the book about what income is community income for California purposes. Obviously, all of the other states are going to have their own rules about that. Generally, community property is going to be any property acquired during the marriage or that they agreed to convert to community property. And then for California purposes, pretty much all income is community income, except for, there's one. I think it's like Social Security, I don't think is community income, but I have stuff in your book about that. Unemployment compensation is community, and pensions and retirement benefits are community. Separate property would be anything you acquired prior to the marriage, anything acquired by gift or inheritance, or anything purchased with separate funds or that was put into a separate property trust.
Question for you, Ryan, please, on the
Yeah.
community property. And you talked about
Mhm.
having a step up in basis. I'm assuming that the step up in basis that you're getting, that's 100%, is only for state tax purposes, yes, and not applying to the
No,
federal.
no, it's for
It's
federal.
federal as
Yeah,
well?
all of this stuff. The federal government recognizes community property income splitting and community property step up in basis. Okay. So
Wow.
the feds say, and it's in the Internal Revenue Code that they respect that. So if the taxpayer is domiciled in a community property state on the Fed return, you've got to do the split if they file separate returns, and you're going to get the step up in basis. So to give you an example, my mom is the breadwinner in our family, and she's married to my dad. Okay. So my mom inherited a huge apartment complex from my grandmother. And for a while, my mom kept that in a separate property trust. But as my parents have gotten older, my mom has moved it into community property. So now my dad, who is quite a bit older than my mom, when my dad said, everybody dies, right? When my dad passes away, because my mom retitled it and made it community property, she'll get a step up in basis on the entire apartment complex. Okay. So the feds look at all of this stuff, and there is planning to be done around community property. Okay.
Awesome. Thank you.
No problem. Um, there are problems that show up. Let's say that we've got a taxpayer and a spouse, and they file separate returns. Even though the taxpayer's income might be community, it's not earned income for the purposes of their spouse. It's just income that appears on the return, but it's not income for the purposes of the earned income tax credit. So that's something to be aware of. You are allowed to do special arrangements with your income in the state of California. So if I'm making 500 grand and my spouse is making 100 grand, we can draft up a legally binding document that says that our wages are not community income, and that will be respected by the state of California. And because it's respected by the state of California, the feds are also required to respect it. So it all comes down for community property down to state law. What does the state that you're domiciled allow for you to do with community property? And again, I pointed out Social Security income is separate per the California courts. You got to look at state law to make that determination. Okay. So if you've got married taxpayers in a community property state, the taxpayer is self-employed and they filed married filing separate, both taxpayers will end up reporting income, but only the taxpayer who worked will pay the self-employment tax. The spouse, while they will report their share of that self-employment income, will not be subject to self-employment tax on the amount. So taxpayer pays the full SE tax, the spouse doesn't pay any of it, but they still split it for income tax purposes. For registered domestic partners, there is not an exception for self-employment tax. And so when you do the split for registered domestic partners, it's subject to SE tax on both returns, but you're only reporting half on each. Okay. In your book, I have some practical, kind of reporting guides for, taxpayers who are in community property states that file separately. One of the primary issues that comes up is splitting the withholding because technically you are required to split the withholding. The problem is that even if you file the community property splitting form with the federal return, sometimes they don't recognize the withholding on the return. And that's just a pain. There's nothing I can do to alleviate that. You just have to deal with it. I have seen some preparers just leave the withholding on whoever's return the W-2 was issued to. The problem with that is that you can have substantial underpayment penalties and failure to pay penalties that can arise from that. So just be aware of that. Again, there are a couple of practical tips in here. The last thing in your book, I'll cover this real quick and then we'll be done. I'm sorry, we're a couple minutes over here. Unmarried mortgage interest. So let me just walk you through this example. So my sister, Isabella, and her now husband, Andrew, when I had written this example, they had been dating for 3 years. And we had always been joking them about saying, hey, when are you getting married? When are you getting married? And so the question here is, Isabella and Andrew have similar incomes. They've been dating for 3 years. They plan to buy a home and they're going to take on $1.5 million loan. Can Andrew come up with a good excuse to keep postponing to Isabella as far as the proposal goes? And yeah, Andrew's excuse here is basically going to be, look, honey, I know that you want to get married, but we're going to buy a house with $1.5 million loan. And if we get married, we only get to deduct up to $750,000 we only get to consider $750,000 of acquisition indebtedness when we're taking a deduction on Schedule A. And if we stay unmarried but we buy the house together, then you get 750 and I get 750, and so we get to deduct the entire amount of mortgage interest. So this is the concept of unmarried mortgage interest. It was a court case. I don't remember the name of it exactly. I think I have it at the end here. Uh, this is Voss v. Commissioner back in 2015. So there's a whole explanation on it and things that you need to watch out for. And that is going to be our presentation for today.
Thank you, Ryan. We have a question from Henry. He says, what happens in a bicoastal marriage, taxpayer in California, spouse in New York, and filing separately?
Oh, good question. So the way that the feds look at community property is they check to see where the taxpayer is domiciled and where the spouse is domiciled. So interestingly enough, when the spouse is domiciled in a non-community property state, their wages that they earn are not community wages. So you do not split those wages. However, the taxpayer they're married, and they are domiciled in the state of California, their wages must be split. So you look to see, are the taxpayers both residing in a community property state? If they are both in some community property state, then you still do the community split. But if one is domiciled outside, their income is no longer subject, but the taxpayer who lives in the community property state is still subject. I know it's weird, but that's the way that they have it written up. And I think I have something on that in your book about, being domiciled. Let me see. Where do I have that? There's a mention about it on page 33, 34, and 35. Yeah, 33, 34, and 35 in your book are going to have information about that.
Great, thank you. And then Frank Deegan had asked on slide 28, does that require a paper return? I was wondering if that was the daycare.
Let me go back to it.
No information, but I didn't know.
So my answer to that was to just jam nines and attach a statement. Filing it paper is probably the more technically correct way to do it.
Great, thank you.
No problem. Cool.
Yeah.
Ryan, just when I thought this was going to be a refresher course, right? You're thinking it sounds so easy. And I'm like, okay, great. This is going to be good. I'm going to refresh myself. And you just taught me what I thought I knew. I don't know.
I
So
know.
let
That's
me
the funny
tell
thing
you.
because we start with head of household and it's like, this is so
Yes.
basic. And then just
Hello.
blow everything up. Yeah.
Oh my gosh. This was like amazing. Thank you so much. All along, I'm thinking,
Thank you.
oh yeah, I've been doing this right. Oh, but just the step up in basis thing. I never knew that you had a step up in basis in a community property state. It's like amazing. I've not done one,
Yeah.
but should one come my way, I am armed with the information. I am ready to go.
Absolutely. That's why I love living in California. I like San Diego specifically because of the weather, but also like we've got so many people out here. We've got so many tax professionals, and our laws out here suck. Like the way that California sets up their tax law and the community property stuff, it's a mess. And so I'm happy to live somewhere where I get to work with it all the time.
Yeah, amazing. This was great. I don't know about you guys, but there was a lot I learned today. So thank you
Thank you.
so much. Thank you for this. Ooh,
Thanks.
Yeah.
I was like attentive to the whole thing.
This has been amazing, and I love the way you organized and presented tonight's and last week's webinar. It's like, huh, when I saw the titles, what's this going to be about? And
Mhm.
it's just really a nice way of organizing. And I see we're getting lots of nice feedback in the
Yes.
chat.
Thank
And
you.
I just wanted to say, again, we're so pleased, Ryan, to have had you with us for this mini series of 4 webinars. I just think it was terrific. To our attendees, I hope you all enjoyed them as much as we did.
Mhm.
And again, please watch your email and check our website. Our upcoming webinars are posted. And I think until July 15th, we've got a deal for you. You can get the whole series, $259 as an NYSSEA member, $399 if you're an NAEA member, not an NYSSEA member, or maybe you just want to become an NYSSEA member too. Who knows? Then we have a non-member price, future member price. And July 15th, we'll have Clarice Landreth talking about CSED issues. August 19th, Aaron Perry, EA, present on accounting fundamentals and essentials for tax pros. Frank Deegan returns with tax law research in the IRM. That's on September 16th. And then October, don't forget our annual conference. Come join us in Saratoga Springs. That's October 25th to 27th. And also for our annual meeting this year, which will be virtual, we'll have an hour from Matt Metris on Form 1099-DA. That'll be a freebie, a thank you for attending our annual meeting. Then in November, we've got a 3-hour presentation from Larry Pon on Social Security and IRMA issues for tax pros. That's November 18th. And winding up in December with Michael Miranda on retirement distributions after Secure Act 1.0 and 2.0. And then, of course, in January 2027, we'll have Frank Deegan and Catherine Keene again for our traditional federal and New York update webinars. That'll be January 6th for Frank and January 20th for Catherine. All right.
And just one last thing, we are starting back our new member mixer. So we just want to make sure that we are getting our new EAs together, giving them a platform to just talk about anything that they want to, their journey as an EA. And so we will be having this on Wednesday, July 22nd, 6 to 8 via Zoom. Come, bring your favorite glass of wine. Come and join us. And this is not just for our new EAs. We're asking all of our members to join us because we feel that as members, you can have valuable information to share with those new EAs. And when we talk about new EAs, I'm not talking about somebody who's just joined NYSSEA. I'm talking about those people who are, you may have joined, but you haven't really been active. You're still not sure to navigate, being an EA. So come on out and join us on Wednesday, July 22nd, 6 to 8. And all of our members are welcome. So please join us. You will be getting that email coming out soon for you to come out. You don't need to pre-register. Just be available. Okay? So you guys have a wonderful evening. Thank you as always for joining us. And Ryan, we love you.
Thanks
Thank
for having me
you.
back.
Thank you
To
so much. We're going to keep you around. You're a keeper because we're not letting you go.
I appreciate it.
So thank you,
Thank you.
everyone. Have a wonderful evening until we see you again for
Thank you,
our next
everyone.
webinar
Good
live.
night,
Have a good night.
everyone.
Bye,
Hey,
everybody.
thanks, Ryan.
Thank